Close your eyes for a moment. Picture your retirement. The beach, the garden, the freedom. Now picture the money that's supposed to pay for it. Your pension. It's sitting in a vault somewhere, safe and sound, growing slowly, right? What if I told you that money isn't in a vault? It's on a trading floor. And the people managing it aren't just buying safe stocks and bonds. They're making bets, complex, dangerous bets. And in many of those bets, you are the collateral. This isn't a conspiracy. It's a business model. To understand how your future became someone else's gamble, we need to start with a quiet revolution that began in a place that smells like chlorine and desperation. For decades, the deal was simple. You worked, you paid in. Your employer and the fund managers acted as fiduciaries, a fancy word for adults in the room. They invested conservatively in boring stuff. The goal was preservation, safety. The prudent man rule was the law. Then something changed. People lived longer. Companies made bigger promises. And that gap, the funding gap, grew into a multi-trillion-dollar canyon. By the early 2000s, pension funds were facing an impossible choice. Admit they couldn't keep their promises, or find a way to make impossible returns. Think of it like this. You promised to buy a mansion, but you only have the budget for a studio apartment. You have two options: get a second job, or go to the casino and bet your rent money on one spin, hoping for a miracle. Guess which path Wall Street was selling? Enter the alternative investment salesman. He had a solution, a magic box. He said boring bonds wouldn't cut it. To hit those return targets, to close the gap, they needed sophistication. They needed leverage. Here's the new pipeline. Your monthly contribution doesn't go straight to Apple stock. It goes into a master fund. And that fund writes a check to a private equity firm or a hedge fund. These are the alternatives, the magic boxes. Inside these boxes, the rules are different. They can borrow insane amounts of money, 10, 20, 30 times what they have. This is leverage. It turns a 2% gain into a 40% gain. But it also turns a 2% loss into a catastrophic wipeout. They can also short companies, a bet that a company will fail. And they use derivatives, which are essentially bets on bets. So now your retirement isn't just invested. It's the stake in a high-stakes side bet. But it gets weirder. To get these market-beating returns, funds often use a strategy called risk parity or volatility targeting. In English, they use computer models to decide how much to gamble based on how calm the market seems. When the sun is shining, these models say, step on the gas, borrow more, bet bigger. This pushes markets higher artificially, but it means everyone is piling into the same trades. Everyone is on the same side of the boat. And when the storm hits, and it always hits, the model screams, break! Everyone sells at once. The losses aren't gradual. They're a cliff. And here's the final cruel mechanic. Your pension fund pays for this privilege. Huge, fixed fees, 2% of assets, 20% of profits that flow straight to Wall Street, rain or shine. In a bad year, you still pay. The fund managers get rich on the attempt. You only get rich if the gamble works. The incentives are misaligned. In 2008, the storm hit. The magic boxes blew up. This was the turning point. Not because they lost money, but because of the reaction. Faced with catastrophic losses, the funds had a choice: be honest or double down. They doubled down. This was the point of no return. They were no longer investing to grow savings. They were gambling to recover losses. The strategy had fundamentally changed, from safeguarding your future to using your future as betting chips to bail out the fund itself. The consequences of this bet are unfolding in slow motion all around us, and you are paying for it, even if you don't have a pension. First, the broken promise. To fill the gaps, cities and states cut services. Libraries close, parks decay, roads crumble. Your taxes go up, not to build anything new, but to backfill a bad decade of bets. New hires get worse benefits, creating a generational war. Second, your pension is now the engine of financialization. Where does that private equity fund get its money? From your pension. So when that fund buys up 10,000 homes and jacks up rents, or loads a beloved company with debt until it collapses, your retirement dream is fueling that. You are both the victim and, unknowingly, the arsonist. Third, we've built a systemic time bomb. Pension funds are now massive, interconnected, and leveraged. When the next crisis comes, their forced selling could be the crisis. The Fed might have to bail out your pension fund to save the market. Imagine that irony. Finally, the ultimate injustice, the upside-down incentive. The fund managers, the consultants, the Wall Street bankers, they get their fees, win or lose.
They've already won. The risk has been transferred to you, to the taxpayer, to the next generation. The game is rigged so the house always gets its cut, while the players shoulder all the risk. So, when you look at that deduction on your pay stub, you're not just saving. You're subsidizing a broken model. You're paying for the previous generation's underfunded promises and the current generation's risky bets. You are the ultimate backstop. Look at the numbers. The average state pension is only 78% funded. That means for every dollar promised, there are only 78 cents in the vault. In some states, it's far worse, below 60%, below 50%. This isn't a prediction, it's an accounting fact. And to chase that missing 22 cents, they take more risk. This creates a deadly feedback loop. A market dip doesn't just cause a paper loss, it widens the funding gap, forcing even riskier bets to catch up. It's like trying to fill a hole by digging faster. Now, follow the money one step further. The consultants who advise the funds are often paid by the very firms they're recommending. It's a closed ecosystem, a professional courtesy. The trustee, the consultant, and the banker all win if the deal happens. They only lose if they do nothing, so the machine must be fed. And what about you? The beneficiary, the member. You get a quarterly statement, pages of indecipherable legalese. Your only choice is trust, or the illusion of choice. This is the heart of the modern compact, calculated obscurity. Make it too complex to understand, too boring to question, so the bets can continue, unnoticed, unchallenged, until one day the letter arrives, not from the market crash, not from the recession, but from an actuarial adjustment, a benefit reduction. The math has spoken, the promise has been broken, and the worst part, it was mathematically inevitable. The unsettling lesson here is not that people are evil. It's that the system has evolved its own logic. Pension funds aren't betting against you out of malice. They're doing it out of mathematical desperation. They are trapped in a game they cannot win, playing by Wall Street's rules, with your money as the only ticket to stay at the table. The original promise, security in exchange for a lifetime of work, was predicated on a world of predictable growth. That world is gone. What remains is a vast, fragile financial experiment where your future is the most traded derivative of all. We built a machine to eliminate the risk of old age. And in doing so, we concentrated all that risk into a single fragile leveraged bet. The bet isn't on companies or on markets. The bet is that the 21st century will be more prosperous than the 20th, that the music of growth will never stop, and if it does slow or stop, the only tool left is to reach for more risk. This is the unsettling lesson. We cannot promise yesterday's security with today's returns. The attempt to do so doesn't safeguard futures. It transforms them into the ultimate speculative asset, your future, traded on a screen you cannot see. The purpose was security, de-risking a lifetime. The mechanism has become speculation, the outsourcing of risk. When security demands a 7.5% return in a 2% world, security is no longer possible. Only gambling remains. The bet was never on the market. The bet was that you wouldn't notice where your money really is until it's too late to ask for it back. We have traded the visible, understandable monster of the printing press for the invisible, complex deity of the digital ledger. One was a tool of desperation. The other is a tool of permanent, technocratic management. This is the great monetary evolution of our time, hidden in plain sight by an outdated metaphor. We abandoned the printing press. What have we built in its place? Who controls the Enter key? This isn't about conspiracy, it's about comprehension. The first step to understanding the economy of the 21st century is to delete the old image from your mind. So I'll leave you with this one question. A question that isn't about villains or simple answers. Was this a catastrophic failure of management? Or was it the system working exactly as designed? What do you believe?